Okay, so in this lesson, we're going to add some more transactions to the ones we just covered in the last video. So a couple of vocab words to go about here. Revenue. Revenue is an increase in equity resulting from the sale of goods or services. So what revenue is money coming into the business from the regular operations of the business. So if Michael Delgado goes out and creates a web page for somebody and they pay him money for that, that is revenue. It's coming into the business because that's the whole point of the business. Sometimes you will allow businesses to pay you at a later date. So just like in the last video where we went and bought supplies on account and we paid for them at a later date, we're going to allow some of our customers to pay us at a later date. So the first transaction, receive cash from sales. So this account called sales is going to be an equity account. We haven't really added sales, so we're going to just work with capital. So received cash from sales. Cash is going to go up because we're receiving cash. Michael Delgado's little pot. So remember I said capital is kind of, you can think about it, of his little pot of what he has invested in that business, what he owns of that business. Since he went out and did the web page, we brought that money in. He's the sole owner of the business. That makes his capital account increase also. And that's revenue coming in. The next transaction is sold service on account. So basically the same thing. Sales, sold services, same type of transaction. The difference is this time, Michael Delgado goes out to Main Street Services. He works on their web page and he leaves, and he doesn't walk out with $500 in cash in hand or a check in hand. He sends them a bill a week or so later. So accounts receivable, which is an account you're going to receive cash on, goes up by $500. And the capital account, because again, this is revenue, is also going to increase. And if you can think about these accounts receivable, accounts payable. Accounts payable are accounts you have to pay money on. Accounts receivable are accounts you're going to receive money on. So the next one, right here, it just brings our balances. So after those two transactions, we add up the left side, our cash, our accounts receivable, supplies, and prepaid insurance equal 3720. Add up your liabilities and owner's equity accounts, they also equal 3720, so we're still in balance. So our four rules that we're looking at here. Two accounts affected. So both of these transactions had two accounts that are affected. If the accounts affected are on opposite sides of the accounting equation, which means opposite sides of that equal sign, then they move in the same direction. And so in these two transactions, they both go up. And then our accounting equation stays in balance. So an expense. An expense is an amount that a business has to pay basically to operate their business. It could be a cell phone bill. It could be rent. It could be rental expense. All kinds of different expenses that come into play when you run a business. And the owner is responsible for paying those expenses. So expenses are going to decrease our owner's equity account. So in this transaction, pay cash for communications bill for a cell phone and internet, because if Michael Delgado is building web pages, of course he has to have the internet. And so in this example, he's paying cash. So cash goes down. And when we talk about paying cash, he's probably writing a check, but we'll get to that later on. So cash goes down, and Michael Delgado's little pot that he owns in the business also goes down by the same amount. So again, our four rules: two accounts, opposite sides of the accounting equation, so they moved in the same direction. They both went down in this example, and our equation stays in balance. Another expense, this time's an equipment rental. So basically the same thing. He had to go out and rent some equipment to do something, paid $400 for him. So the cash account goes down, and the Michael Delgado's capital account, his little pot, goes down also. And then again, our balances are still equal. So withdrawal. A withdrawal is when the owner takes out assets of the business for personal use. So really what happens in the real world is a lot of times, if you own a small business, you don't give yourself a regular paycheck because it will depend on whether or not the business is making any money and bringing money in. Because if they're not bringing any money in, there's no money for you to take out. So unlike if you have a job and you make $10 an hour and you work 20 hours this week, that business owes you $200 and they're going to give you a paycheck for that. It's not how owners typically pay themselves. They do it as they make money and they take out what they call a withdrawal. So we're going to do one other transaction, then we're going to do a withdrawal transaction. So the first transaction here is receive cash on account from Main Street Services. So we went out a couple of slides ago and we did that service for Main Street Services, and we showed where they owed us $500. So in this account, they're making a payment to us. So our cash goes up because we're receiving cash, and what Main Street Services owes us goes down because they paid $200 of their $500. Now that they now only owe us $300. So in this, if we look at our 4 rules, 2 accounts affected. This time they're both on the same side of the equation. So they're both assets, so they're on the same side of the equal sign. So one went up, one went down to keep our accounting equation in balance. So the next one, paid cash to owner for personal use. Michael Delgado withdrew equity in the form of cash for $350. So cash went down because he took cash out, and capital is going to go down, and we call that a withdrawal. So he basically took $350 out of the cash of the business and gave it to himself as a payment for something. And so again, our 4 rules to accounts. This time they're on opposite sides, so they moved in the same direction. This time they went down, and our accounting equation stays in balance. So just kind of a summary here. We had some different transactions. We had a revenue cash coming in, and it changed our owner's equity for the positive. We also had a revenue on account that we sold on account, and our equity went up $500. Then we had 2 expenses we had to pay. So our expenses, it went down $480. Then the owner withdrew equity of $350. And so the net change to our owner's equity was $770 increase.